All right, this is Drake Taxes practice return number 5. What makes this a little different than just doing it straight off of these practice returns that Drake Tax provides, that I create fake tax documents to make it seem like what you would get from the client, as well as how I would prepare these tax returns. So for this one, we'll call this essentially the tax organizer, the basic information that the client will provide for you. So a little bit about them is they're married, they have one child, they both live in Chicago, Illinois. They provided their fake driver's license information so that way you can put them into the software. Here are their names, what they do, their date of birth, their socials, their address for both spouses. They do have a dependent. They have a daughter. They also send the daughter to daycare. Also gives some other basic information for when you fill out the tax forms. What makes this a little bit different is going to be that they have rental income. And usually a client will either give you something like this where it just kind of tells you their expenses for the rental property, or I provide a template for their rental properties and in Excel format, and they can fill that in for me. This also lets you know how much rent they received, how many hours they spent on it, which actually doesn't matter in this scenario. When they place the rental in service, the type of real estate property it is, which is dependent on how many years the property is going to be depreciated, how much the building was bought for, and how much of it was land. And that's pretty much about it. So I usually start off with the W-2s. So this is kind of what you would get from the client. Their wages, their tax withheld from the company. This is Illinois. No state taxes withheld. Their spouse also has wages, taxes withheld. And in this scenario, they also had unemployment income, similar unemployment income, federal taxes withheld. And this is for the state of Illinois. So I typically start off with my reconciliation in Excel. And so here is Nimbus Media for one of the taxpayers, wages, federal tax withholdings, Medicare wages, and then it's Illinois still state wages. Same with the spouse. And then this one I just input in here just for the federal withholding for the unemployment, since my reconciliation doesn't flow from where I input the unemployment income, which is right here, unemployment income. So I input right here, so that way it flows to the right tab, which is their tax payments. So I input that in. Their rental income's next. So they indicated they had $36,000 of rental income. This is a long-term rental they had for 365 days throughout the year. This is their address is in Illinois. The tax organizer did say that, let's see, some of the expenses, these expenses were directly to the rental property, and these were shared with the property since it's a duplex. So we have to cut these in half. So here's that 50% for the insurance, $500 in full for legal fees, $2,500 for repairs, 100%, $500 for supplies, 100%. And then the taxes and utilities were cut in half because it was shared on both sides of the duplex. Here's the depreciation, but this information comes from the tax software. And I'll show you that in like when we look at the tax software. And fortunately for state, it's the same depreciation. So it's going to be the same. So there's no state and federal tax differences. And hypothetically, if the state depreciation will be different, then yeah, there'll be a adjustment, whether it's if the state depreciation was lower, then you would have to add more income to the state income to calculate the taxes for the state. If they had more depreciation for the state, then of course the income would be reduced and you'd pay less tax at the state level. This is my other income tab. This is for unemployment. Schedule A, I just have it in here, even though they take the standard deduction. Here are their payments. So this is the payments from their W-2. They also indicated that each quarter that they paid $500 in estimated taxes, probably to compensate for the income that they got from their rental, since no taxes would have been paid out of that unless they adjust their W-2 or their W-4 form and have it taken out of their W-2. This is the state of Illinois, pretty straightforward. I essentially took this off of the tax software. So after that, I don't look at the first tab quite yet. I go into the tax software, which I would input their name, married filing jointly, occupation, date of birth, name, date of birth, occupation, no foreign accounts, no digital currency or digital assets, address, resident is Illinois. They had one dependent, entered all this stuff in. They paid $5,400 in childcare expenses. There's some due diligence that you typically have to fill out. That way they're not just making up stuff about a dependent to get the tax credit. Wages should be pretty straightforward. It should match the W-2 form, box 1, box 2, box 3, box 4. Illinois made up the employer state number. Here's the state wages. And then did that for both of them. Wages, federal tax withheld, state. And then 1099-G is the unemployment. Unemployment right here, federal taxes withheld over here. And then their IDs I input over here, just fake. Due diligence checklist, just kind of make sure that you asked the right questions. You did your best to make sure that information was correct. Let's see. Oh, the rental income. So put in their address. This is kind of where if you were a real estate professional or if you did the short-term rental loophole, but by default, they're active in the rental real estate. The address, you can put whatever description you want to put in there. I usually put the address or the beginning of it. Since the duplex, we put as multifamily and indicated that it was not a trade or business, so it's not eligible for QBI deduction. They assume that all 1099 forms have been filed if necessary. 365 days that it was rented out, the full year, $36,000 in rental income. Here's the insurance, legal, repairs, supplies, taxes, and utilities. And to go back to it, this page is essentially what I will send my clients, and then they can fill this out, and essentially it mirrors the Schedule E. And then, of course, other expenses if they have, I don't know, pest control, landscaping, and whatnot. But most of their stuff they can fill out in these lines that are straight off of the Schedule E. So this helps my inputting of the tax software much easier. Oh, and you might have, normally there's mortgage interest, so you would fill out this form 1098 since you'd copy it over from the tax document that you get. They had no mortgage interest apparently. In this fake scenario, and this is where you enter in the asset in form 4562. So I usually put building, duplex, the address so I can keep them separate because they might have more than one rental. Date acquired could be different, but for this scenario, I just put the date acquired as the same as the date placed in service because it could be different. You could buy it like 5 years ago and then decide to turn it into rental. And this is where you would write the place in service, different date, so that way it calculates correctly. The cost is $275,000. It is residential rental at 27.5 years. And the land is $100,000, which does not calculate into the depreciation calculation. So there's that for the rental. There's the depreciation. Let's see. Yeah, child care credit. Entered in the fake information that they provided, $5,400. They are not a household employee. They went to somewhere with an EIN number, like a daycare center. Due diligence checklist. We already talked about that before. So estimated taxes. So this is where you put $500 each quarter. I didn't put the dates in there. Sometimes you can put the date in there to see if they paid late, and they will calculate penalties and interest for you. If you don't put a date in, it just assumes that it was paid on time. And that is pretty much about it. When you calculate it, the first page, basic information up here, married filing jointly, their kid, they get the child tax credit. Here are their wages combined. Here's the income from their Schedule E rental or their rental income. Rents, all the expense we talked about, and then their depreciation. So you would think that depreciation should be $10,000 because it's $275,000 divided over 27.5 months. However, the first year it's calculated based off of mid-month. So the month of January, it's assumed that it was placed in service the middle of the month. And so after the end of 27.5 years, that final year, it'll also be a mid-month calculation. So therefore, it's a little bit less than 10,000 because they don't have that full month of depreciation, even though they said place in service January 1st. So here's like the net income from it. And if you had mortgage interest, it'd be right here. And keep in mind that even though you make a full mortgage payment, only the interest portion of it is going to be deductible for tax purposes. So in some scenarios, well, I guess the depreciation expense is non-cash. So a lot of times the difference between your actual mortgage payments in full is offset. I'm sorry, the mortgage payments in full isn't going to be fully deducted. So let's just say you have $2,000 a month mortgage payment. It's $24,000 that you had to pay, and your interest on that is only $14,000. So you'd have $10,000 of principal payments that you paid towards your mortgage that you didn't get a tax deduction from, but you get this depreciation expense of almost $10,000 that you didn't have to pay money for during this year, and that's an expense. So essentially it offsets it. So that kind of helps in terms of not paying too many or not paying taxes on the amount of money that you paid out. If hopefully that makes sense. Hopefully it wasn't more confusing than anything. But just remember, depreciation expense is a non-cash expense. You don't pay any money out of pocket, and then the mortgage interest is only deductible. Only the interest portion of it is deductible. So that's where this number comes in. This is your total income, or AGI. You get the standard deduction, or they get the standard deduction. Your taxable income is $83,539. The tax on that is a little under $10,000. They do get a child tax credit as well as a child or dependent care credit. And so their net tax is $6,959. They already had $10,975 withheld from their paycheck. They also had $54 withheld from the unemployment check. And they paid $500 every quarter, so they had an additional $2,000 of tax payments. So the net of all this is that they overpay by $6,000, and they should get that as a refund. So hopefully that makes sense for federal. Now let's look at Illinois. So Illinois starts with the federal adjusted gross income. They have some exemptions for the spouse as well as the taxpayer, so two people. They also have a dependent, so the total exemption is $8,325, brings down their Illinois net income to $104,000, and then their tax for residents is 4.95%, so their tax is $5,168. In our scenario, we assume that they had no state taxes withheld, so therefore their Illinois tax is $5,168, and it should match my reconciliation, which I think we had before, $5,168, plus the index should match $86,000 for the W-2s, $21,000 for the rental property, and then $5,000 for the unemployment income. Standard deduction of $29,300. There's a taxable income. The ones in green I input. I don't want to do the calculation on here. So I just pulled it in. They get the $2,000 child tax credit, $600 dependent care credit. They also have the $2,000 quarterly estimated tax payments. These amounts were already withheld from their unemployment or their W-2, and their overpayment is $6,070, just like it is in the tax software. So it is getting a little bit, or these tax returns, practice problems are getting a little bit more complex. This one had rental income, and most of the time the client isn't going to get everything so perfect, but at least hopefully this helps with understanding the concept of how to input the data in if you have rental income, and also kind of how it works with the depreciation as well as the deductions for the mortgage, even though we didn't have an actual mortgage interest on this one. If there's any more questions, please leave that in the comments.